Hey friends, welcome back to my YouTube channel. If you're new here, my name is Bianca. And since my previous day in the life as a VC analyst video, a few people actually reached out to me to ask, what does a VC analyst actually do on a day-to-day basis, like job description wise? And since the VC industry is just rather opaque to outsiders for some strange reason, I thought I might as well just help out and share a little bit about the kinds of things I do in my job, which I hope can be really insightful for anyone who might be just considering a career in VC. So here's the thing, it's like 8 a.m. now and I actually gotta go to work. But you know what, let me just bring you along and we can chat more about it along the way. Okay, let's go.
But before that, in case you are new to the VC space and need some context, here's a mini crash course on it. So basically, venture capital is one of the three main subsets of private equity, where the term private equity essentially translates to capital investments made into private companies, aka companies that aren't listed on any public stock exchanges like Nasdaq. In the case for VC investing, the money goes into funding early-stage startups with high growth potential in exchange for a percentage of equity in the business. This may lead you to wonder, okay, cool, but how do you define early stage? Well, that would largely depend on the VC firm you're working at. Generally speaking, startups opting for venture capital funding will need to go through multiple rounds of fundraising. And to a large extent, there really isn't a universal rule as to how founders should label their fundraising rounds. But the earliest stages would typically begin with either the pre-seed or seed stages. So, depending on the founders, pre-seed or seed stage could refer to the period in which they are just beginning to kick off their operations, or it could mean that they might have already started and are just looking for ways to finance their core activities. And this could include things like product development, market research, or hiring a founding team. At this stage, the money can come from VCs, the founder's own pockets, or if they are super lucky, the free Fs, or more popularly duped as family, friends, or fools. Or okay, to be more politically correct, fools are technically angel investors, who are usually high net worth individuals, such as those starring on Shark Tank and Dragon's Den. When it comes to Series A, most startups would have usually demonstrated some level of product market fit, whether it is through their growing revenue or by having sold a meaningful number of products. So, VCs at this stage would usually come in to help the company continue improving their products, or in some cases, to help scale up their operations to serve more customers. Moving on to the Series B, C, D, and onwards, it's really all about taking the business to the next level, whether it is by expanding into new markets or geographies, bulking up on business development efforts, hiring more people. At this point, the company is way past the development stage. With that, this is where some VCs come in to help scale the company as quickly and as efficiently as possible. But here's the catch. We all know that 90% of startups fail, and since most startups seeking investment from VCs won't have enough operating history to prove that they will be the next Google or Amazon, there's just no guarantee for VCs to have a positive return on investment. But the fun part here is, if you manage to make at least one right decision, you will be making a lot of money from that investment alone. And when I say a lot of money, I mean the ceiling can go up to millions or even billions. And mind you, that jackpot alone would usually be enough for a fund to bring in above average returns on investment.
So, no pressure, right? But let's not jump the gun and stressed out, because the journey to making an investment in the first place is oftentimes a lengthy one. I mean, no one in their right mind is going to want to make an investment that they know is going to fail. So this is where our role as a VC analyst come in. It is quite literally our jobs to help our companies make better investment decisions, as well as figure out how we can make the startups that we have invested in much more valuable over time. So how do we do that? Well, let's just broadly segment the tasks that junior level VCs usually perform into three main segments outlined in blue. The first step is deal sourcing. Basically, this is a process by which VCs hunt for deals, aka promising startups that we could potentially invest in. And the number one thing that you gotta remember is that VC investing is kind of a numbers game. This basically means that the more startups you meet, the higher your chances of finding a unicorn, aka a startup that's potentially worth more than $1 billion US. That being said, there are two main ways in which VCs can get access to more deals. The first approach is inbound, so think, please give me money. In the sense that startup founders would directly approach VCs in search of funding, where examples of such would be direct emails or LinkedIn messages from the founders themselves, or it could be referrals from, say, other investors or other startup entrepreneurs, or even the financial advisors to these startup companies. The second way would be outbound, so now think, please take my money, in the sense that these are startups that VC firms would proactively reach out to. And because of that, VC analysts may need to go out into the field a lot to attend events such as pitch competitions, trade shows, industry conferences, networking sessions, and so on. This therefore makes it super important for VC analysts like myself to just constantly work on our relationship management skills. You can never know who is going to be your future business partner. With that, your ability to get people to like and trust you may as well be one of the biggest deal breakers as to why startups may choose to work with your VC firm instead of another. Let's move on to the second job scope, due diligence. Now, this is where the bulk of the work is going to kick in. In most situations, startups making it this far would usually need to jump through 3 more hoops before any VC check is written. And these 3 hoops, in short, are basically called strategic, financial, and legal due diligence. Right, I won't dive into the nitty-gritty details, but just to give you an idea of the things you could expect, imagine yourself spending a lot of time building loads of financial models, running sensitivity analysis, investigating competitors, visiting remote locations, validating legal contracts, coordinating with third-party auditors, and so on. But something to just bear in mind here is that the level of due diligence you tend to perform would usually depend on the VC firm you're working at. Meaning to say, some VCs may not perform a super in-depth due diligence, whilst for some VCs, I've seen them practically like stripping the company naked and just scrutinizing every single component of the company. Some can be more extreme than the others, so it really depends. Now, fast forwarding to the VC having invested in a startup, VC analysts may now get the opportunity to participate in the portfolio monitoring process, which is all about supporting the portfolio company's performance over time. Similar to the due diligence step, the portfolio monitoring process would largely depend on the VC firm that you're working at. But if you see the term value add on the VC company's website, they're usually referring to the type of support that they're able to offer to the startups during the portfolio monitoring stage. And the types of support VCs can offer can typically range from bringing in potential customers or talent, to helping startups in their future fundraising efforts, to bringing in a financial advisor to the company if they are looking to become publicly listed. I mean, at the end of the day, it would largely depend on what the startup founders themselves would really want to do with their own company and whether the VC firm has the network as well as resources to help them achieve that. And now that that's all done, what's next for VC analysts? Well, we do that all over again and seek to perfect that craft. As you can clearly see, being a VC analyst is clearly a lot of work. So let's just take this opportunity to briefly discuss what you really need to have if you hope to succeed as a VC. If I were to be really honest, although having the technical financial analysis as well as management consulting skills are pretty essential, I would still argue that it is the soft skills that truly separates the best VCs from the others. And in my personal opinion, there are a few non-negotiables if you truly want to be the best of the best. First of all, you really got to be passionate about startups and innovation, in the sense that you're not doing this purely for the money. Because truth be told, if you're looking for a super high-paying finance-related job, you might as well work at an investment bank, because I would argue that that's probably a better bet. Not meaning to say that VCs don't pay well, but it's definitely not one of the most lucrative jobs out there. But having said that, most VC analysts I've met actually enjoy their jobs very much because their role really enables them to get super involved in building companies. So, depending on who you talk to, I would say that many of them actually found their jobs to be super meaningful because they get this opportunity to try to build something out of nothing. Next in line, I do believe that customer empathy is key. This is all about learning to view the product from the user's perspective. So, when in doubt, always take the extra effort to understand the world around you and why people are the way they are. To do that, I would just strongly encourage you to constantly try to live the user experience whenever you're trying to assess companies. For example, wondering why or how is TikTok so successful? Install the TikTok app and try it out yourself. Trying to study the e-commerce sector instead? Well, this is the perfect excuse for you to just go online shopping so that you can get a glimpse of the entire value chain. On top of that, try to just imagine the world 8 years down the line during the company's early stages. Ask yourself, would the world still need this product 8 years down the line or something else? Are we just ahead of our time, or will this product become obsolete? Why would customers care or not care about this? Question all of that, and I can assure you that this can serve as a really useful guiding light when you're trying to search for future investment opportunities. Number 3, you got to be a truth seeker. Well, in the sense that you gotta just show commitment to the truth, not consistency. For some weird reason, there seems to be this myth going around that if you want to be a really good VC, you gotta be contrarian. But the reality is, being right is far more important than being a contrarian. So I would always encourage everyone to just be mindful of the potential reality distortion bubble that we could be living in. And whenever necessary, dare to be bold and unconventional when it feels like it's just the right thing to do. For example, if you truly believe that a startup is worth or not worth investing in, whilst others may not see it the same way as you, have the confidence to stand your ground. But of course, make sure you have the solid reasons to justify that. With that pretty much sums up the kinds of things VC analysts like myself would do on a day-to-day basis. Realistically speaking, no 2 days are exactly the same at a VC because our schedules can be pretty unpredictable. But as long as you have this genuine passion for entrepreneurship, I truly still believe that you will enjoy your job and actually thrive in such an environment. On that note, thank you so much for taking the time to watch my video. If you found it to be insightful, do consider hitting the like, subscribe, and bell icon. And if you're wondering how a random day in my life as a VC analyst looked like, check out this video here to find out more. Till then, I hope all of you have a wonderful day ahead and I will see you in my next video. Bye bye!